Welcome to the latest Motley Fool scoreboard. I'm Anand Chokkavelu, and we've got longtime fools Toby Bordelon and Rick Munarriz giving a 1 to 10 rating to online furniture store and member of the single letter ticker club, Wayfair, ticker symbol W. Talk about the strength of Wayfair's business first, including factors like industry and competition. A 10 is invincible, a 1 is hopeless. Both of you have 6s, Rick.
Yeah, so if you're a fan of furniture and decor, Wayfair is a cool playground. It offers more than 30 million products through more than 20,000 suppliers. Some work through its fulfillment centers, others go the dropship route. It's a game of quantity over quality, and Wayfair's reputation is at the mercy of its often distant suppliers who can deliver on Wayfair's value propositions of free shipping on orders of bulky furniture pieces. It has some degree of ubiquity, so I'm going with a 6. But at the end of the day, a shanty is dandy, but wicker is quicker from a local provider.
Yeah, say 6 for me here too. They seem fairly strong for what they are, right? But they unfortunately compete against the likes of Amazon, Walmart, and IKEA, all of whom offer cheap and serviceable, in some cases popular furniture items, often via online channels and home delivery too, right? It's just a tough market. The key to success is a strong, efficient supply chain, and all those other companies are masters at logistics, so it's hard to get an edge over them. The current environment too, right? Fears of a recession paired with a weak housing market, not great for Wayfair. They do well when lots of people are buying new houses and moving, as you might imagine, and we don't get a lot of that right now. And I'm just not quite sure, guys, that the online focus for furniture is the future of this industry. So I'm going with 6 here.
It is an incredibly tough market, both in physical locations and online. For management, a 10 is Warren Buffett, a 1 is Homer Simpson. Both of you have 5s this time, Rick.
Yeah, so co-founder CEO Niraj Shah has been at the helm since starting the company in 2002. Co-founder Stephen Conine is also still on board. The two of them are co-chairmen of the board. I love a good founder CEO story, but then I checked Glassdoor, and I find that Shah has just a 22% employee approval rating. That's one of the lowest scores I've seen for a sitting CEO. And then I remember that he suggested that his employees were lazy in a year-end email back in late 2023. And a month later, he laid off 13% of his workforce. So I'm going with a 5.
Yeah, I mean, the fact that the founder is still there leading the business, I guess that's worth something, right? Even if perhaps he hasn't led it as well as we might prefer. But stability is good, right? Shaw does have a plan for jumpstarting growth, and I do like management teams that have a clear plan and a focus. No guarantee it's going to work out. Some of their problems, I think, maybe a lot of their problems are beyond their control, like the economy, the fact that furniture is big and heavy and expensive to ship, right? So I see management as okay, but maybe trying to run a model that just doesn't work in the industry that it's in. IKEA doesn't try to do everything online, right? There's a reason that furniture stores are still doing well in the era of online shopping. So my problem with management, they may not be inherently bad. It's more of a knock on them for thinking this was a good idea to begin with and persisting with it in the face of evidence that it's probably not going to work. Now, that said, Rick is right. There is a history of poor relationships with employees and investors, too, to some degree, failed international expansion. So there's definitely been some poor decisions here.
Financials, a 10 is a fortress, a 1 is yikes. Toby's at a 5. Rick, you're at a 4.
Yeah, there aren't a lot of people that wish that they could go back to 2020, but Wayfair would bottle that year if it could. It's the only year that it generated a positive operating profit in its public history. Revenue soared 55% that year. Revenue has fallen every year since. Wayfair is still losing money on a reported basis. It has $3 billion in long-term debt. A 4 might be generous.
Yeah, I'm a little bit more optimistic than Rick. I went with a 5 here, but it's not great. As you know, Rick, revenue isn't growing. They're losing money. They're burning cash. The cash burn, though, that's key one. That tends to be life for them. But they do have $1 billion in cash on hand, right? Debt's not getting much worse, even if it's not getting better. They were cash flow positive at the end of last year. There's hope here, but I agree with you. It's not great, and I do want to see some improvement here soon.
Toby, let's get to the magical question and talk valuation. How well will Wayfair stock do over the next 5 years? How safe is it? 10 is a sure thing. 1's a lottery ticket.
I got to say 5 to 10% on the return. Honestly, I think it might be on the high end there. The stock could be at a low point. I guess if you're optimistic here, I do expect near market matching returns over the next 5 years here. Safety, though, just a 5 here. It's going to be volatile for sure. There's a ton of competition in the space. They aren't super well positioned to ride out an extended economic downturn. Now, I'm not saying they're going to go under, right? But it's not where I would want to have my investment capital if I were concerned about a recession.
Yeah, I'm also 5 to 10% return, a safety score of 4. Wayfair has shed more than 75% of its peak value, but it doesn't mean that it's cheap or safe. Its trailing revenue is double its market cap, but this is a low margin business with a moat that is moot. I'm a bit more optimistic on the 5-year return than the stock safety because a lot can happen in 5 years. There's a strong chance that we see a recovery in the housing market at any point in that time. And if it happens to coincide with a climate of low interest rates, Wayfair might party like it's 2020 again, at least for a year.
Let's move on to everyone's favorite topic. Toby, is there a company in Wayfair space that you like better?
Oh, IKEA, definitely, right? But that's not public, and I'm guessing our viewers want some investable ideas. So let's go with Williams-Sonoma. Great furniture and home goods retail business here. They've got a good e-commerce strategy, but they also have a ton of brick and mortar stores for a good reason. So this is a company I like in this space a lot.
Yeah, I went with Lovesac. So they're a seller of high-end beanbag chairs and sectionals that they call Sactionals. It sells mostly through local showrooms, but about almost 30% of its business is online. It trades at a similar revenue multiple to Wayfair, but it's different in much better ways. It's consistently profitable, trading for less than 14 times forward earnings. Unlike Wayfair, Lovesac would go on to post several more years of double-digit sales growth after 2020. The streak ended last year, and revenue growth did turn negative, but I still like its premium positioning. And not only is it 14 times this year's earnings, it's 10 times next year's analyst target. So that's way more fair than Wayfair.
Thank you to both Rick and to Toby. They've given Wayfair a low overall score of just 5.0 out of 10. Look out for a new scoreboard every market day at 7 p.m. Eastern. Next up is Match Group. Till then, Fool on. I like that. Can't make a mistake. I like that.